When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shea, and I'm just here to ask the questions, but of course the words of wisdom and solid advice, they come from Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Hey Jeff, how's it going for you this weekend?
Going awesome. How are you doing?
I'm doing great, thank you, now that I'm with you and talking to the fine people here of the greater Tucson area. We've got a lot to talk about on the radio program today, so let's get started with that. Market turbulence. Allocation to U.S. stocks saw the biggest drop in March with concerns over stagflation, trade wars, and the end of U.S. what they're calling exceptionalism. I'm not sure what that is, during a bull crash in sentiment. So what do you make of all this, Jeff? And I know the market has been sort of in correction territory. Should we as investors react to this at all, or do you recommend staying the course? And what's your reasoning behind what's happening?
Well, I think you need to be very nimble. I haven't really been too exposed to the stock market anyway. When we are, we try to buy stocks that have relative strength and good fundamentals. What I mean is that stocks that seem to go up on the down days and don't get sold off 5, 6, 7, 10% in a day. We're seeing the Magnificent Seven, the big stocks that, have driven this market over the last few years. They're flat to down over the last 6 to 12 months. So basically everything you made last year has pretty much been given back just in the last few months on those major stocks that are driving the market. So if you have a heavy exposure to those things that you think, oh man, these are the best stocks to have, these are the blue chips. Well, they're not blue chips. They're basically overextended, they're overvalued, and they're ready to correct more. So you have to be pretty careful. It's not a buy and hold market. It hasn't been for a while, even though if you did buy and hold last year, the market was manipulated enough with QE and backdoor QE to the banks and the Fed and the games they were playing to kind of mask the real problem. And that is that the economy isn't doing that well. The manufacturing has been going down for the last few years in every sector in the country. Manufacturing jobs have been sent overseas. They at the threat of having corporate taxes raised and everybody paying their fair share, meaning let's take more taxes so we can pat our own pockets and build our own wealth. And that's what the elected government officials were pretty much living that dream. The American dream is get in the government and take taxpayers' money and pretend it's yours and spend it on whatever you want to and find your way into building some sort of backdoor LLC that you can funnel money into, or have election contributions made by the companies that you prop up for silly things. And we've heard all that from Doge. But the fact is a lot of this economy in the last couple of years has been fake anyway. And I've been saying that. And the fact is the market always corrects, and it will correct. We don't know when, but the odds are that it's been ready for this for a long time. Now, Trump happens to have been elected, and obviously uncertainty causes a little bit more uneasiness in the market, especially when the majority of investors are Main Street, not Wall Street. Wall Street, Warren Buffett, the big banks, they've been selling stock for the last couple of years. They've been touting stocks. They've been buying their own stock to prop up their own stocks and make it look like everything's hunky-dory. And then they've been also market making, as in just dictating the price rather than have price discovery, which means free market. I'll buy this stock and you sell it to me for this price based on the buys and sells in the market. It's not. It's been dictated by the market makers, where they just arbitrarily set a price, and they'll set a price higher just so they can sell into it. And they sucker the Main Street people who have had tons of stimulus money, many of which have had misunderstandings about the market, but still throw money at it, even though, it's going up. And by the way, if you're young and have plenty of years and you want a dollar cost average in the market, I don't have a problem with that. We had a portfolio that was growth for the people that were still working and had more than 5 or 10 years to wait. And I didn't have a problem offering it to them. We were up 29% last year. So we were able to take advantage of that opportunity. But for most of my clients who are retired, that's not a recommendation that I would make. Just because we can make money, and even if we can keep up or beat the market because we pick stocks that are fairly valued, that have good fundamentals, that have good momentum, and that have this relative strength according to the market, doesn't mean we can always do that. It still doesn't mean that I'm some kind of guru. I'm not. I have a lot of experience, and I can see that the market's in more trouble than the news would indicate. And by the way, I don't know if you've all figured it out, but there's a lot of fake news. It's not just about politics. It's not just about a political agenda. Much of that political agenda is making the market look better than it is, even though the economy's in trouble. Unemployment's been going up consistently for the last 6 or 8 months. Manufacturing's been going down. Inflation's come down a little bit, but it actually started going up again because they stopped lowering rates, or they didn't lower long-term rates. They raised long-term rates just to try to keep it under wraps, and it still didn't work. I think Trump, just like the last administration, doesn't want the market crashing on his watch. But the fact is that there's a big pile of mess that has to be shoveled out of. We have to dig out of this hole. It's going to have to happen one way or another that the market corrects. I don't think it's a bad thing that the market corrects. We have to get back to fair value eventually anyway. The market cannot be so far ahead of earnings forever. Warren Buffett said that very succinctly and very directly in his last meeting about a month ago, where he says, the market's way out ahead of itself, and it never stays out there that long. It always reverts to a more normalized market where price earnings ratios, growth percentages are more in check with the amount of growth in the stock market. If the stock market grows at 20% a year, but earnings are growing on average by 6%, that's kind of a disconnect. If earnings are growing by 1 or 2, which is more like what they have grown in the last couple of years, then it's a very big disconnect, and we just get more and more overvalued as we go. So, the fact that money's coming out of the market is really more, I don't think it's because it's a scared thing. I guess that might be the catalyst for it. But the fact is we're due for that. There's too many stocks that are overvalued that are trading at like 100 price earnings ratio or more, that just because they're in an industry that we think might benefit by AI. And even though the future projections over the next couple of years don't get those earnings ratios down below where they are right now, it's just unrealistic and unreal. There's a thing called the CAPE. It's a Shiller ratio. Basically, it uses the actual 12-month rolling current price earnings ratio, and it's around 38 to 40 right now as far as what we're willing to pay. Based on last year's earnings, the last 12 months earnings, we're paying $38 for $1 worth of earnings. The normal is somewhere between 15 and 16%. So our market is double valued if you look at history. And if you look at that Shiller price earnings ratio, the CAPE ratio and you can Google it and you can see where we're at. And we're at historically abnormally highs. I mean, we've only been this high. We haven't even been this high, I don't think, except for the dot-com bubble, which was a bunch of things with dot-coms that didn't have earnings, didn't have revenues, didn't have anything but a name that ended in .com. That blew the market out of proportion, and we know what happened. We had tech stocks going down 80%, a lot of people having to go back to work, and some people that couldn't go back to work had to adjust their lifestyles and change their retirement plans, unfortunately. So we're kind of on the verge of that. I'm not trying to be a doom and gloomer, but I've seen these cycles before, and I've seen them hurt people. And I don't want to get my clients hurt. I don't want the listeners to get hurt either. And that doesn't mean you can't make gains. It means let's just be cautious while the market does its thing and corrects and gets back to normal value. When it does that, you've got a decade ahead of you where you're going to double or better your money. But the thing is, if the stock market goes down half in the next 6 months or a year, or even if it had done in the last couple of years, and it takes 10 years to double your money, you're just back to even in 10 years. Why not just hold your own right now? Wait for this correction to happen and wait for us to get to a more fair value area and then double your money every so long. And when the market's not conducive to making money, let's just keep your profits, keep your life savings safe, not be overly greedy. I know everybody wants to win. Everybody feels like they have this fear of missing out. And so they want to throw money at the market. Right now, we're seeing people buy the dips. We're seeing short covering rallies, these little bounce backs that make it look like, oh, good, the stock market's finally on the bottom. And you even hear it on the news. Kramer and all those guys that are just cheerleading the market is like, oh, it's time to buy. Oh, the market's down 6%. Oh, it's time to buy the dip. Really? Well, it's still overvalued. If you buy the dip and a stock should be trading at $20 and it's trading at 120, just because it goes back to 100 doesn't mean we should buy it at 100. We should probably wait till it gets down to 20 or 30 again. And it probably will when the reality sets in that these stocks are just way overvalued. And we're going to get some institutional selling, and then we're going to get the fear that creeps into Main Street. And then they're going to go, oh, no, what do we do? We've got to save our money. And then they're going to bail and run for the covers. But guess what? The institutions, the pension funds, the hedge funds, they've already run for cover. Warren Buffett's already run for cover with a third of his assets. He's got over $1 trillion in Berkshire Hathaway, and over a third of that is in cash. Why? Because he's going to buy low. He's going to buy the dip. Now, he can't go all cash. I think it looks like he's trying. I mean, shoot, he's got to have a third of his positions in the last couple of years. Why? Because he's smarter than you and I. He's smarter than me. That's why I listen to him. That's why I watch what he's doing. That's why I'm not going to bet against Warren Buffett. You got these young 30-something hedge fund managers on the news saying, well, we're all in, we're buying this, we're buying the dips, and this market's never going to be different. Well, guess what? They never lived through the last 3 crashes like I did. They never lived through the last 10 crashes like Warren Buffett did. So we know that these cycles happen. We know that it's about to happen. So let's protect our assets and don't lose our assets while we're waiting for the market to get better. Hunker down, enjoy the ride, enjoy retirement, enjoy the fact that we'll probably get some de-inflation if we have a recession. We'll probably be able to refinance the debt at a much lower interest rate if we have a recession and the market corrects or even crashes. But we don't want to be in the crash if we don't have time to wait the rebound out. If we've got just very little bit of money in it and we're dollar cost averaging in because we just started our job and we have a good job and good solid foundation in that job, keep doing your 401ks. Keep dollar cost averaging into the market and ride it out if you don't need that money for several years. But if you want to protect it, if you're getting close to retirement, I think the story is a whole different story. Unfortunately, I see too many people getting crazy and saying stuff right now like, oh, well, the market's down. I'll get out. Yeah, I got to get out. But I'm going to wait till it gets back, or I'm going to wait till NVIDIA gets back to $140. Then I'll get out. Well, what's NVIDIA like this week? Like 112, 115, 110? It's down 30%. Well, it's down basically to what it was 6 months ago or more. Do you want to really bet on it going back up before it goes down some more and maybe takes 5 or 6 years to get back to the 140? The market corrects and crashes. That might be the story. I don't know. But the fact is if you bought NVIDIA at $100 a year ago and you could get out at 115, you're still making 15% on that. You're locking in a profit. Why are you going to get greedy? Try to wait till it goes to 140 and find out that it goes down to 60. And I'm not making a stock prediction here. I'm just using a stock everybody knows and using what markets can do to stocks. Honestly, I hope NVIDIA doesn't go to 60. I mean, if it does, I'm a big buyer. But I'm not a buyer at 150, and I'm not a buyer at any of these stocks that are trading at 50, 60, 100 price-earnings ratios and an uncertain future, especially when we have the deep-sea competition with China and things like that in the AI world, where we don't maybe need all those super high-powered chips. Maybe the market is being a little bit overhyped and oversold. Maybe we have to rethink it a little bit. I think these corrections gives us pause to kind of rethink the market, get rational again. And I think it's healthy that the market returns to rational areas. And I think from that, we will build a base that is so strong. And with Trump in control of the White House, he's not going to make stupid economic blunders, I don't think, that would derail or make a crash a permanent situation. It would be just a nice foundation and a base. It would create a base to bounce off of and see maybe the best 3 years of the 4 ahead of us. This next year, I think there is a lot of uncertainty. There's a lot of things that we have to fix that was purposefully broken in the last administration, I think, in order to keep Americans basically at the feeding trough of the government. And guess what? Trump wants to empower every American to make his own way and not have to go and feed at the trough of the government and actually build their own wealth and build their own successes and feed their own families and be more self-sufficient. If we can do that even in the next 4 years, I hope we can. And I hope we can keep the momentum going with a couple of more administrations before people get tired and get this crazy woke or green agenda ideas or this U.S. aid. Let's piss away the taxpayers' money because now we're having so much abundance. We need to throw more money away on stupid things. I hope we don't get to that point again, but I think that's where we are right now. And I think as that is getting fixed, there's a little less liquidity going into the market. It is, in a way, quantitative tightening. At the same time, Trump wants to lower interest rates, which is quantitative easing. The Fed says, no, the economy's still good and looks like inflation is just finally getting in check. But we're seeing things like retail sales down. The consumer discretionary purchases are going way down. They're not buying extra cars and washers, dryers, and new furniture and all the things that are, even Starbucks. Those kind of things are pretty much discretionary. You don't need $8 coffee. You can buy it cheaper. Make it yourself, pennies on the dollar. So, we're seeing that kind of a shift and it's going to affect the market. I don't mind it. But again, we're still in the market. We're still trying to take advantage of, like I say, those relative strength stocks. Now, the dollar seems to be getting hit pretty good. The dollar is not really highly valued. So guess where a lot of money's going? Gold and silver. Shoot, look, we got gold over $3,000 an ounce. And some market makers are saying the next level is going to be 3,200. I think that's probably very realistic. So there's another 6 or 8% in gold, and the mining stocks might even do better than that. Silver is kind of lagging. That's another area that you can make money during this downturn. What about energy stocks with high dividends that seem to hold their value? That's another place that's a little bit more of a safe haven. And something that's even better when the dollar's devaluing like it is foreign exchange traded funds. I mean, foreign markets are actually undervalued. They didn't get overly stretched like the American. I mean, shoot, they were spending all their money here. Now that they're pulling their money out of America, going back into Europe, guess what's happening to Europe? Those are the strongest moving stocks and funds right now that are out there. So, I mean, there's all kinds of ways to play this, but you have to be keeping yourself in touch with the market. If you don't have the time to do it all day yourself because you like to golf and retire and have fun, that's what we do here. We look at the market. We watch what our hedge fund managers are doing. We watch the sectors that are getting hot. We look at all kinds of trends in the market. We look at where the money's going. We follow the money as best we can. That doesn't mean we don't still take a little bit of risk when we think there's a good buy on a stock that's been overly sold and we think we can buy it at a good value and wait it out. But we're not going to overpay for stocks. That's just a death wish on your financial fortune and your financial future.
That's Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. This is a commentary part of our program. If you hear anything that piques your interest, maybe you want to get in and sit down with Jeff and talk about how these issues will affect you and your journey towards a prosperous retirement. We are offering this retirement roadmap at no cost and no obligation whatsoever to our loyal listeners here on this radio program. The number for you to call to get yours, no cost, no obligation, 520-780-9059. 520-780-9059. I know you're listening to the program on the weekend, but go ahead, make that call right now. Leave your name, telephone number, say, hey, Shelley, give me a call back. That's all you got to do. Shelley will call you back during the week and set you up with an appointment for you to come in and sit down with Jeff. Now, it's just going to be a casual conversation. You don't need to bring your tax forms or anything like that. Just a chance for you to sit down with Jeff, get his ideas, allow him to get to know you, you to know him, and figure out whether this is going to be a fit for us here. Again, no cost, no obligation, 520-780-9059. Make that call because this one call really could make all the difference in the growth of your wealth and your retirement planning. Jeff, let's talk about the elephant in the room today. Trump and his trade and tariff strategies are causing some waves. What do you think we should expect moving forward?
Well, I think more uncertainty. I think people don't understand them. So when you don't understand something, you get a little bit worried. I think if we look at the long-term effect of tariffs, first of all, they're bargaining chips, like I mentioned. If you've got Canada charging us 200% on a tariff for butter, actually, I think it's like 700 or something like that.
Right.
But they can send their dairy products here for a 10% tariff. Well, it's not really fair trade because we'll never sell or export any of our stuff to them. If we say, okay, we're raising you to equal, so we're going to raise it to 700, everybody goes, oh, well, that's stupid. We can't trade with each other. Well, that's fine. We'll just trade with ourselves. And then a month later, you look at each other and you're like, well, that was stupid. You know what? Why don't we just get rid of this tariff thing and just trade with each other? Okay. Well, guess what? There we go. Free trade. Everybody wins. America is a huge consumer. Now, America wants to be a big producer, but because we consume so much, we're net importers from everybody. It's not like we're going to bring all this manufacturing home because of tariffs and all of a sudden we're going to be supplying the world. There's nothing we can do in America to supply our own demand for consumption. I mean, we're pigs, we're hogs, we're gluttons. We buy too much stuff. I mean, we might not think so, but compared to the world, we do. So I think just in making the free trade, it's going to allow us to continue to export more of American goods that are wanted all around America. And if they can be at affordable price, great. And if other countries can ship more of their stuff that we want into America and they can make money, they can thrive, they can have more money to buy our stuff without tariffs. And they can sell more stuff here. We can consume more stuff because we're gluttons and pigs. And we like to do that kind of thing as Americans. But we need to not be taxed out of all of our money so we don't have money to consume like we like to consume. We like to have stuff. We like to have nice stuff. America's been the land of prosperity and possibilities and dreams and all those things for so many Americans for so many years. And it's like it's being given away lately, and we get to get that back, and tariffs are a big part of that process. So I think it might be a negotiating process. I think eventually, if nothing else, we just make it kind of a fair deal. And I don't know all about the ins and outs of economics. I'm pretty good at economics. I had a business degree, studied economics quite a bit, and I understand the whole philosophy behind economics and how the market works. And it doesn't always correlate. Sometimes it correlates by the manipulation in politics and some of the things that the Fed does behind the back of true economy. But at the same time, you have to understand economics and what Trump's trying to do with tariffs to understand that they're not really a harmful thing in the long run, but it does create uncertainty. They are inflationary in general right up front, but look how fast they've been renegotiated. Every time he says, I'm going to do something, they go, wait, let's talk about this. Okay, we'll hold it off for another month. the market settles in and we have a couple of good market days because everything's so good, maybe we're not going to have tariffs. So it's like, no, we're going to still have them. We just don't know how much they are yet. So as this negotiation process takes place, yeah, we're going to figure out just kind of how it settles in. But I don't think people give Trump quite enough credit for what I think he knows about economics. I mean, he's really good at it, and he ought to be given a little bit more credit, and we ought to just sit back and write it out. Now, that doesn't mean, however, that there's not going to be a correction. Like I said, just in the last segment, I don't think that there's anything we can do to get out of some sort of correction and some sort of pain. And I don't know that Trump isn't already aware of that and knows it's going to happen. Of course, he's not going to broadcast it. Hey, I think I'm going to cause a recession so we can have lower interest and we can pay down the debt with lower interest because we don't want to refinance $7 trillion of debt this year at 5%. We'd rather do it at 3 or 2 or 1. I don't think we can get interest rates down that low, but we do have some issues that we need to work through. And a good market correction and a little bit of a recession might actually help the cause rather than hurt the cause. So I don't think they're going to be as bad long term. I think in the long run, it's going to increase domestic manufacturing. Government revenue here obviously is going to be higher. Maybe they can tax us less or keep our tax rates a little bit lower, quit taxing more stuff. And I just mentioned it. We'll be able to trade more stuff. We could also reduce the trade deficits with those extra taxes and not keep living at a $1 trillion deficit with a budget that is out of control. I think when we get these negotiations, I think just from a national security point, even there's some benefits. So I don't think it's all doom and gloom. I think it might be a catalyst or maybe a reason that they say the markets sell off. The reason that the market's having a problem, that's because it's all Trump's fault because of the tariffs. But there's a lot of other things that are causing us to be in a recessionary state right now. And those things happened long before Trump was in office. Some of them happened while Trump was in office his first term with the COVID and with the bailouts and the stimulus that happened then. And the fact that supply chain got all messed up and everybody had to go home and be stuck in their houses. And the workforce just has a different idea about what's expected. And yeah, everybody wants to work at home and not do anything and do as little as possible to get paid as much as possible. And I think we have to get that work ethic back and we have to kind of crank up America again. And I think it's going to probably take a recession before everybody realizes, hey, this is bad. I got to get back to work and make good things happen. I think if Americans do that and we get back to the way it was pre-COVID, where everybody had opportunities, everybody had upside, everybody gave a full day's work for a full day's pay. Not everybody did, but I mean, there was a lot more of that, I think, than what we're seeing now. People have learned to take too many shortcuts and get bailouts, and we need to stop that and make America great again by making America work and be efficient and actually live and participate in the American dream again, not just waiting to see if it gets handed to them.
Jeff, something that you talked about, bringing manufacturing back to the United States, something that I learned, which I was really shocked about, is that a great number of pharmaceuticals that we use in this country are actually manufactured in China. China could just say, hey, we don't like you anymore. We're going to cut you off. I mean, then what are we going to do? Do you think that there is real hope for manufacturing things such as pharmaceuticals in this country?
Well, I think manufacturing of pharmaceuticals need to come back here. I think Canada has some manufacturing a little bit. Mexico does a lot of that as well, but I think they buy all the parts to the drugs from China anyway. But, right. China makes such a killing by selling us those drugs. They would shoot themselves in the foot if they actually cut us off. I think they could probably cry about it or make some sort of a tariff demand or try to do retaliatory tariffs on drugs, which would just increase the drug manufacturers to bring stuff home, maybe do it more in Canada and Mexico, especially if they become more our allies across the border instead of trade enemies. But, if we can have more of a free trade agreement and not need China, that would be really good. And I bet China starts towing the line and gets back in order as far as controlling the fentanyl and some of the other things that they need to do in order to keep that gravy train going to them. So I don't know that it would dry up. It is kind of scary that we're dependent for so many things that actually sustain people's life with one country. And that's concerning to me. I just have to hope that, their economy demands that they keep that pharmaceutical flow flowing as well. And, if there's a few hiccups and bumps along the way, I'm sure we'll get it fixed by increasing production in other places.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and also Mesa. We've been talking about current events and the Trump tariffs and trade war. If our conversation piques your interest, you want to get in and sit down and talk with Jeff, we are offering no cost and no obligation for this Premier Retirement Roadmap. You can get yours right now by calling 520-780-9059. When you call, you'll leave your name, telephone number. Shelley will call you back, set up a time for you to come in and sit down and talk with Jeff. It's a casual conversation so you can run some ideas by Jeff. And if you've got a portfolio from somewhere else, you want a second opinion on that, Jeff is happy to do that for you. Again, no cost, no obligation. 520-780-9059 is our telephone number. You can also find out more about the firm online at premret.com, premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we're going to answer listener questions and more when our show continues. Right here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're on the air for you 4 times a week here on KNST. We're on Saturdays at 7 a.m., then at 9 a.m. and 1 p.m. We're also heard on Sundays at 11 a.m. And if those are not convenient times for you, you can go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan, as well as our website at premret.com. You'll find this show and many of our past shows so you can stay on top of your journey towards a prosperous retirement. Once again, our telephone number, 520-780-9059. You can go ahead and make that call this weekend. Leave your name, telephone number. Shelley will call you back during the week and set up an appointment for you to come in and sit down and actually talk with Jeff about your individual situation. Okay, Jeff, time for listener questions. And this week, as always, we have 3 of those. And we're going to start it off today with Glenn listening to us in Tucson. Glenn says, although everyone has a different situation, at what tax bracket does it make sense to start converting your 401k into a Roth 401k and pay the taxes up front? For example, I'm 42 and my wife and I have a combined income of $560,000. That puts us into the 35% federal tax bracket. We have $2.5 million in a traditional 401k 403b account. Assuming we both retire at 67, does it make sense to start converting into Roth accounts and take the tax hit in the next 5 to 10 years compared to 25 years from now?
Well, actually, in a 35% federal tax bracket, you're in your 40s, and so $2.5 million might double a couple more times between now and the time you retire, especially if you keep on putting money into it. So you're looking at maybe $10 million in traditional IRAs. Now, keeping in mind at that point, you'll be taking $300,000 or $400,000 out of there just to keep up with the required minimum distributions by the time you're at required minimum distribution age. So you'll probably end up trying to live on a similar lifestyle that you are right now. You'll probably be in a very similar tax bracket. I don't know that I would rush to convert a whole bunch to Roths. Maybe from here on out, you just add to the Roth rather than add to your traditional 401k and just take a little bit of a tax bite and let the tax deferred part grow, and then try to convert that between, if you do retire at 67 and then you have a few years between there and the time you have to take the required minimum distributions out, maybe when you retire, maybe you'll be in a 31 or a 28% bracket and you can move $200,000, $300,000, $400,000 a year over to a Roth and convert. Sometimes it's worth just taking the hit up front. I have clients that are in a position where they'll never be in a lower tax bracket. Right now, we know we have the Trump tax cuts and the highest, you're pretty much knocking at the door of the highest tax bracket in 20 years. I'm guessing just because of the way the government works and the fact that Trump and fiscally conservative people won't be in the White House forever, that taxes are very likely to go up in the future. So from that standpoint, I would say maybe you do some Roth conversions, bite the bullet and just say, never again am I going to pay taxes. Now, you've done very well. Obviously, you have good incomes. You're in the higher echelon of incomes for most people. And you're able to save by the time you're in your 40s, $2.5 million. Well, good for you. That's not the norm. You're an exception to the rule. And like I say, way to get ready for your retirement. But you are causing yourself a tax problem. But you knew that when you got good jobs. Maybe what you should have done is put all your extra income, instead of maxing out your 401k and Roth, put all the extra stuff that you're not living on. Well, unless you're enjoying spending it all. I don't know. Maybe you're a net saver. It seems like you've been able to save quite a bit if you've got that much money in 401ks already. But one option is to add a LERP to the mix, life insurance retirement plans, which you can do And if you do decide you need money earlier than retirement, you don't have to wait till 59 and a half to take money out or move it. You can access it kind of like a tax-free bank. So life insurance in a retirement plan works like a Roth. It's a little more efficient. It's more protected from the downside risk of the market and gives you access to some money between now and the time you retire, should you need it, rather than have it all tied up in Roths and 401ks it really can't touch. Should you be going through maybe a career change, or maybe you decide to go back to school and get some sort of a certification. I don't know what kind of job you have, but maybe in the medical field or something where you take a sabbatical and you want to live on some money, but you can't pull it out of your 401k or your Roth. Maybe you want to move overseas and do some charitable type work and you need to live on some of that. That's why maybe having another retirement plan that doesn't have income restrictions, but still has tax breaks like a Roth might be an option to look at to add to what you're doing right now. But it's really kind of up to you. You're probably going to be in the highest tax bracket or brackets for, especially if you're going to work that much longer and you're making as much money as you are. I don't see you getting really into much of a lower tax bracket unless you can, manipulate it a little bit, maybe between the time you retire and the time that you actually have to start taking those required minimum distributions out. Maybe there's a way to move a couple million, but I don't know that that's going to be a big enough difference just for a few years if you're pushing 8-figure retirement funds that are all taxable when you pull them out. So again, you're digging yourself a tax, you're in a tax mess now. You're digging yourself, a future tax mess, and you're taking advantage of a nice tax deduction while you're funding the 401ks, saving 35%, but maybe it is, maybe it isn't worth it. I think in order to answer your question based on what I would advise is, I'd like to see it on a spreadsheet, see the math on what you really like to spend and, what your lifestyle is. I mean, if you're a super net saver because you're frugal, I might encourage you to just spend some more or do some gifting or maybe use some charitable strategies, or either leave money to charities and get income that is tax advantaged. Don't know if you have kids that you're trying to build a legacy for them. How does that work? Maybe with irrevocable trust outside of your estate, because you're also looking at a potential estate tax problem, growing your estate as fast as you're growing it and making as much money as you're making. So you don't have really that problem now, but looking forward in your 40s, at least you're looking forward at the right time rather than wait until you're in your 60s to say, now what do I do? So good for you for looking forward. To get a better answer, probably need to ask a few more questions, maybe sit down for a minute. So feel free to come on in and we can do that. I'll give you a second opinion on how the math might make sense on helping you figure this decision out better.
Glenn, thanks for listening to us right here in Tucson. And again, if you'd like to come and sit down with Jeff, 520-780-9059 is our telephone number. You can make that call right now this weekend. Leave your name, telephone number with Shelley. She'll call you back and set up that appointment. And again, we appreciate you listening to us. We'll send you out Jeff's book, Retirement, The Road Ahead. Jeff, our next question is Bob in the Catalina foothills. And Bob writes, the existence of fiduciary duty does not prevent potential conflicts of interest. Could you explain a little bit more about this idea? What types of conflicts could arise even with a fiduciary?
Well, I think the biggest thing, and I don't know that it's a conflict, but I would say the biggest thing is maybe bias. Maybe just a person like me. I'm a fiduciary, but I lean safety first. You might lean risk. I don't care if I lose money, and I'm probably not a good fiduciary for you, although I'd be one within my value system. But I don't know that it would be a conflict, but I think that sometimes is interpreted as a conflict. There's another conflict that I think is really big. I'll tell you about a couple of them. If somebody calls themselves a fiduciary and only offers securities or portfolio management, is that really a fiduciary, especially when you only have a couple of portfolios that you can offer? And I'll call it out. I'll just say who it is. Fisher. I don't usually call names out, but and I'm not going to call a local firm out because I'm going to talk about one in a minute. But Fisher's on TV, then they always say, oh, Fisher Investments, we're fiduciaries when you do better. They also do fine when you don't do better. They also have pretty much cookie cutter investment portfolios. There's nothing that's customized. They says, we do what's good for you based on your long-term goals. Well, if all they do is supply portfolios that are very risk focused, they're risk on. They say they risk off, but if you look at their history, they don't. And they won't even give you a full history when you ask them for historicals. They'll give you periods of time where they beat the market, periods of time where they didn't lose as much as the market, but they never give you a period of time when they were in all bonds or all money market or just sat the market out for a year or two while the market corrected. They're always in something, and they do just as badly as the market does in bad markets. That's been my experience because I've seen people's statements. I'm not necessarily saying they're bad for everybody. They're just focused on one thing. Now, I like to use all the tools. It's like building a house with just a hammer. Well, you might need a saw and some nails and some other things, to go along with that hammer in order to actually build a house. To build a portfolio or build a retirement plan, you probably ought to have some tax planning in there. Well, they have a disclaimer. And as most fiduciaries that work for a firm, a big firm, where they say, I'm a fiduciary, only because they hold a license that says they're supposed to be a fiduciary. They hold what's called a 65 or Series 67 license, which says you're a registered investment advisor or an investment advisory representative, where you can charge fees. Some of those people also have a securities license called Series 7, 63, or 6, which allows them to sell mutual funds, stocks, and bonds and do things on a commission or a fee, get kickbacks from mutual fund companies and things like that. So they might have both licenses, call themselves a fiduciary, yet use the other licenses as if they're using their fiduciary license, which is more to do the best thing they can within the realm of where they work. So I think the biggest thing to avoid what you might consider conflicts, that may or may not be. I think in a court, you'd have to really prove that there was a conflict of interest. I think self-dealing, for example, if a fiduciary only sells funds where he gets a kickback and never offers you something that has lower fees and better performance, that he's either not looking at enough things. And by the way, there's no way anybody who calls themselves a fiduciary can know everything about everything. So maybe they're a really good fiduciary in portfolio management, tactical trading, and they're really good at that. Well, okay. As long as they're doing what you say, your goals, and they're doing their best based on what they feel is in your best interest. And if it isn't, then you need to have a discussion with them and say, hey, get on the right page. We're not on the same page here. That doesn't mean they're necessarily a bad fiduciary. It might be because they're just misunderstanding. Or maybe your risk tolerance changes when you find out how it feels to be retired and lose 10% in your portfolio where that never has happened before. Or the last time it happened, you were working. And now all of a sudden you say, well, my fiduciary got me out. Well, you're asking the fiduciary to be a mind reader. And that's not fair. So again, I think there's some people that, oh, my fiduciary had a conflict of interest. Why? He might just had a conflict of value systems or a conflict of comfort zone with the market. I will admit there's 2 clients this year. I very rarely lose clients, but I had a couple clients that wanted to be in the market. And I said, you're retiring this year. Why would you want to make me or ask me to risk that much of your money in something that could plummet and be down 10 or 20%? Which would affect your retirement date and affect your lifestyle in retirement if we didn't get out fast or time the exact time that the market fluctuated. And the fact is that person had been with me several years and hadn't lost any money. They were still up. They were still ahead of where they were when they started their retirement plan a few years ago. Unfortunately, that was a few months ago, and they're probably all in the market and probably wondering what they're doing right now because it's really volatile, and they're probably really scared right now. But of course, they left mad because I wasn't a good fiduciary, so I'm sure they're not going to call me back. But that's okay. I'm being real here. I mean, we can be everything that we think is perfect for that client, but the client doesn't always feel that way. And if they don't, then look for somebody that does align with you. That's what you should always do. I get clients from other advisors. Most of my clients don't just come out of the thin air that never had an advisor. Some do because they just had a 401k. They never had an advisor. They need one, but most of them probably have other advisors. They work with other people. Why did they move? Well, because all of a sudden they found out that there were more tools in the bag that they could use. And their advisor only did stocks and bonds, and they weren't really comfortable with stocks and bonds anymore. Great. Let's move into LERPs, annuities, guaranteed income, tax benefits, estate planning, wills and trusts, and life insurance trusts, and irrevocable trusts that protect assets from everything from creditors, predators, and the estate tax man. There's tons of stuff that you can use. So if you want a comprehensive plan and somebody is only putting you into the stuff they make the highest commission on, and it's only in one particular area of the market, then yeah, I think that's kind of on that line of conflict of interest. They're only offering you what they do best on, but not offering you what you would do best with. And again, it depends on the realm of reality in that person or that person who considers themselves a fiduciary. Just because they consider themselves a fiduciary doesn't mean they've been in the business 30, 40, or 50 years and have a ton of experience. Doesn't mean they've ever even read a book on the stock market. It just means they got a job, took a test, passed it, and now they're working for a firm that considers themselves a fiduciary. Or do they have the experience to see to your comprehensive needs? Do they have the experience to understand, have actually dealt with clients like you in your boat and seen the good, bad, and the ugly over the last 20, 30, or 40 years so that they know how to react in different markets or how to guide you through the obstacles that are out there on this road to retirement? You know, it's kind of like getting on a boat and you've got this sea that there's rocks and waves and all kinds of different things and wind and things that you've never done before. And if you get on the boat and you try to navigate it yourself, there's very often a chance you're going to bump into things. You're going to run into obstacles along the way or make bad decisions. But if you let somebody else, like an advisor who's a fiduciary and that is built a business and has experience for 30 years driving this ship through these waters that for you are uncharted, but for the captain of the ship knows exactly the routes to take to miss the pitfalls and the bad things that could happen along the way, like the next market crash. We can drive around it. We can be safe. We can still be on the boat when the market crash happens and still be sailing off into the sunset, enjoying our retirement. But again, just because you're a fiduciary doesn't mean you're the smartest guy on the planet and doesn't mean it's the best guy for you. So there's a lot of people that are, I think, loosely using the word fiduciary because they really only do one thing or use only a couple of tools in the bag. And then there's some fiduciaries that just really have a bias towards stock market because it's the best way to build long-term wealth. Well, it is. And maybe that fiduciary is great for somebody in their 20s or 30s or 40s, or even somebody that has money to burn in their 50s or 60s and has tons of income that's already guaranteed for their life. There's another guy in town that gets on the radio and says, if you're doing LERPs and annuities, you're probably not getting what you're thinking. Like, really? Well, he doesn't even know my client because he's probably dealing with different people or he has a bias against it. Why would you dog on another advisor is doing if it's right for the client? Or why aren't you doing it? Because you either don't know about it, but you're talking like you're a fiduciary and that you know all the things you shouldn't do. Guess what? The tools are in the bag because they're useful for some things. Annuities wouldn't exist if people didn't like them. Life insurance wouldn't exist if rich people didn't like the tax benefits from tax-free income in retirement and a stealth account that never sends a 1099 to the government to let them know how much you have in it. There's a lot of reasons to use some of these other tools that some of these people on the radio that are trying to down talk me or other radio programs that like to maybe offer a more comprehensive plan. And they say, oh, don't do that. Do what we do. Well, first of all, I'm not going to give you recommendations on the radio or tell you not to go to another advisor if they're doing what you want. I'm just saying this is how we do it different. We use these tools. And if you like us, come kick the tires here. But again, I think there are some conflicts of interest. And I think the biases might be just based on their history, based on their ideal client and other factors that might make it look like there's conflict of interest where there may not be. But there definitely is some conflicts of interest. I think a lot of it is because they work for a company that ties their hands and doesn't allow them to be a true fiduciary for you.
Bob, we appreciate that question. It was a good one, good short question, long answer, but nevertheless,
of course,
we appreciate you listening to us in Catalina Foothills. Well, I'd rather you give an in-depth answer, Jeff, than just blow it off, but it was a very good question. Again, thanks for listening to us. 520-780-9059 is our telephone number. Come and sit down, talk with Jeff, ask any questions that you have. 520-780-9059. You can call that this weekend, and Shelley will set up that appointment for you. Okay, next question, Jeff, is Sharon listening to us in Marana, and Sharon says, is it best to work with an advisor who's an independent or part of a large firm? I'm not investment savvy, and I'm entering retirement. I need to make sure that I hire someone or a firm that's going to help and maybe is somehow insured.
Well, it's interesting. Insured. The big companies are insured. I'm a little company and I'm insured. I'm a little company because I like kind of the more family atmosphere and I like treating my clients like members of the family and giving them the best I can. I don't plan to be a Merrill Lynch. I don't plan to grow and develop this zillion office firm with a zillion advisors I don't even know and have to somehow be responsible for and babysit and who knows what they're actually doing just so I can build something with a big name on it and be famous and sell it for $100 million so I can retire. I'm not into that. I really like my job because I like helping people. I mean, if you want to be a number in a big firm, you can. Are they any more insured than I am? No. In fact, they're so insured that if you try to sue them, you'll probably never win, even if they did do something stupid and lose their money, just because they've got such deep pockets and they're really pretty much insulated against bad things that happen. It's kind of interesting. But the smaller guy, we have to have Arizona emissions insurance. If we steer you the wrong way and we're responsible for bad decisions, you get to tap that insurance. It's usually millions of dollars on a per claim basis even. So, and I'm not suggesting that you go and do something stupid so you can sue an advisor, but the fact is, in order to even have our license intact, we have to have insurance against stupidity, errors, omissions, maybe just bad advice. Now, that doesn't mean you have a right to sue somebody if they don't have a crystal ball and can't tell the future. But if you tell them you want conservative investments and they put all your stock in one stock like NVIDIA or Microsoft or Google or something, and it goes down, I mean, you probably have a really good case of suing that person and getting some money back if they lose your money. If you say, hey, I want to be really aggressive, and they put yourself in the Magnificent Seven, and you get mad about losing money. Again, I think the biggest thing to do is work with an advisor that listens to you, that can do what you want. And keep in mind, a lot of times the people in the big firms are brand new because they're working with new clients. And if they're any good, they get moved up to work with other clients, unless you're one that they can take with you. Or they wash out and you get a new rep a lot. So some of the big firms are kind of a turnstile operation where you don't even know who you're going to work with on a regular basis. At least here at Premier, even if I have reps, and I do have them, a few sub reps that work with me, and my son in Mace office is one of them. And from time to time, I have other people that service accounts. I mean, if anything happens in this firm, I still know what it is. And we're small enough to where the buck stops here. I can still look over their shoulders and make sure their planning is right. I make sure that the decisions that they make or the suggestions that they make in the annual reviews are in line with what you put on your profile as your risk tolerance and what your goals are. So I still can be very hands-on without being in the face of everybody, but I don't know how that can exist in a bigger firm. So it kind of depends what you want. Find somebody that, can really be nimble and work and be very comprehensive and very custom to you, or work with a big firm that typically has less to offer because they're only given a certain framework within the work and certain options that they're given that they have to sell you. And even though they look big, you'd be surprised that they're actually more restrictive in their offerings. So consider that. If you want to kick the tires at a big firm and kick the tires at some small firms, hopefully we're on your short list of people you'll visit, and we can help you make that decision.
Sharon, we appreciate you listening to us in Marana, and of course, we'll send you out Jeff's book, Retirement, The Road Ahead. We invite you to call us here and sit down and talk with Jeff. He'd be happy to answer any questions that you might have. 520-780-9059 is our telephone number. And by the way, if you have a question for us you'd like us to answer on the air, you can get it to us by calling it in to Shelley if you want, 520-780-9059. You can also go out to the website, premeret.com, Premret.com, and ask the question there. And of course, if we do answer it on the air, you'll not only get a great answer, but you also get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. And we appreciate you joining us this weekend. Jeff, I know there are a lot of people driving around listening to the program today. Maybe they have a financial plan or a portfolio with another advisor, but they're somewhat unsure that they've got the right plan or the right portfolio or the right advisor. What are some of the questions that you think that people should ask themselves or indications that maybe they are working with the wrong financial planner for them?
Well, if you feel happy with what you're getting, then that's the first step to say, well, okay, so far I'm happy, but do you know what other options you have? Maybe it's worth getting a second opinion or going to one of these seminars or something where you just get a flavor of more of a comprehensive thing. I think the biggest thing is probably lack of communication or understanding of your actual goals. The people that I have walk into my office are typically, well, I told the guy I was conservative. I'm down 20% and I'm still in bonds after 2 years. Why am I still in bonds? They've gone down 20%. Like, well, maybe you should be buying them now, but you shouldn't have held them all the way down. You could have got out of them in March of 2022 like we did and start buying them in December this year. So there's things that a lot of people just do, like a kind of a buy and hold and just, oh, well, the market does this, market does that, and just ride it out. And it's just to set it and forget it. You're not really getting your money's worth if the person isn't actually aligning with your goals and serving you and making adjustments along the way, doing regular reviews. I mean, annually at least. We kind of bite off our plans on an annual basis. If you don't see us 3 or 4 times during the year, that's okay. If in the meantime, there's changes that need to be made, I'll let you know, or I'll make the changes. So as a financial advisor and as a fiduciary trying to do what we set up, on an annual basis or regular basis, some clients are a little bit more needy or have a more specific plan for a very short period of time where we want to meet on a regular basis, maybe quarterly, and make adjustments along the way. Or if we see the market changing and we know you're a conservative investor, we're going to dial back the risk. We're going to go risk off. You're not going to have to call us and tell us to do that. We're not going to call you and say, hey, is it okay if I take you out of risk because you said you want to be conservative? Or do you want to change your mind to be aggressive? Well, if you want to change your mind to be aggressive, you better tell me. I'm not going to just assume that, right? So again, you have to have some sort of a level of communication that you feel comfortable with. Make sure that you understand why you're doing it. Now, you're never going to understand everything the advisor does for you because, for example, I've got 35 years probably ahead of you in your financial education. You're not going to catch me, but I can at least help you understand why we're doing this. Like we're doing Alert because you want to save taxes with your income. We're doing an annuity because we want you to have guaranteed income to supplement your Social Security so you know that all your bills are paid regardless of what the market does. We're going to be aggressive with this account because it's not enough to change your life, but it's enough to make a difference if the market does well. And over time, this is your future money or your legacy money, and we can be aggressive with that money, or at least understand which each bucket is doing and why you're doing it. Product picking, good luck. I think I'm probably better at picking products. I'll show you a few if you want to help me decide. But we know the annuities that pay the highest income. We know the annuities that are best rated. We can help you decide and focus on those products, but you know why you're getting one.
Jeff, unfortunately, we're running out of time for this week, but I thank you for that answer, and I want to thank our listeners for listening to us today. Once again, our telephone number, 520-780-9059. Call us and set up that appointment to talk to Jeff. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.